good morning. You're watching The Market right here on 18 Hour with me, Aisha Faridi, Avan Dabash, Nikunj Dalmia also joining in. And the global market cues, US markets did close a little bit lower. You've got the oil prices, though, that continues to be a niggling factor. Remember, Brent has now scaled up all the way to that $90 per barrel mark. So that's pretty much the global setup. Let's just see what Asia as well is up to, while GIFT Nifty once again is indicating a very, very quiet start for us. And yesterday, we marginally edged higher to close up about 0.2%. So pretty much status quo, Nikunj, when it comes to the global setup.
No, Aisha, it's not looking that great. I mean, frankly, if you ask me in terms of shakeout, no, shakeout is not the right word, but there is definitely a ripple, so to speak. Let's look at all the contours here. The dollar index is at a 6-month high. That's the first indicator of which way the risk is moving. Bitcoin has slipped. Euro is at a 3-month high, and the bond yields are inching higher. Why do bond yields inch higher? Very simple. If the markets are expecting inflation to stay stubborn, or they expect Fed to increase rates. Now, Fed has already opened doors by indicating that a rate hike cannot be ruled out, and looking at the scenario, they cannot commit to a pause, and they've kept that statement open. So that has coincided with the surge and comeback in commodity prices, strengthened the dollar index, and that has led to an appreciation in the bond yields. And there is a little bit of risk off which has happened in Bitcoin. So I'm saying that you got to just be watchful now in terms of the data points. And there's no alarm bell. But in terms of the tone and the tonality, there seems to be a subtle indication coming from the currency market and from the bond market that you just cannot assume that rates will go lower, and you cannot assume that Fed will not move again in the second half of this year.
And should the Indian market investors then derive that, you've got to even up your warning signals antenna further?
Aisha, look, you look at the market from the eye of Nifty. Frankly, you've done nothing. And let's look at the YTD graph for the Nifty. Now, with all the hullabaloo in the market, where the market cap is, let's first look at the Bank Nifty and the Nifty YTD. That, in a sense, will really establish that where the market has moved. The Nifty in this year has appreciated by 9%, or I can just say just 9%. Bank Nifty, despite the leadership sector, has given you a return of 3%. But the minute you turn your attention to the small and the mid cap index, it's a completely different kettle of fish. The small cap index is up 27%. The mid cap index, is up 27%, and for the small cap index, the gain is 30%. And I'm not even getting into individual stocks, and I'm not even talking about what is happening in the SME space. Historically and traditionally, when you have seen these levels, the market, at least in the mid and the small cap stocks, either tends to correct or it tends to consolidate. I think we are reaching there where the markets are due either for a sharpish adjustment or some degree of consolidation. We are not at a bubble level. We are not at a euphoric level. This is not 2014 yet. This is not 2008 yet. But in terms of a risk-reward ratio, now is not the market where you just want to be blinded with momentum. You want to be careful. You want to be in capital protection. And if you cannot take a 25 to 30% downside, I guess this market, mid and the small cap space, may just not be the right space to be in right now.
Yeah, perhaps run its course already. And just yesterday, it was interesting that we were talking about previous instances in which we have seen the broader markets take leadership. But just to paint the picture, yesterday, the cues from D Street is that you had the frontline indices. It was a choppy day of trade. We ended around the 19,570 mark. 3 straight days on the trot, at least, that we've been seeing that gaining momentum and leadership being witnessed within some of the large caps. So they look like they're coming back to the forefront, the likes of RIL, for instance, ITC, or even Infosys. While FIIs remain sellers, DII is the buying figure. That continues. 13 straight sessions on the trot. And yes, the broader markets, you saw the year-to-date chart, bulk of it has happened in the last 1 month itself, and quoting at life highs. So Nikunj, DII is remaining net buyers, and the fact as well that you've also got leadership from some of those large caps, and just tracking the technical RSI levels as well. What is that indicating?
Look, not everything in the market is overbought. Not everything in the market right now is underappreciated. Now that is how things are looking up in terms of the RSI level. Mid cap, small cap and the real estate index are overbought right now. And when indices have reached what are called as these overbought levels, the future return in the short term, it tends to get compromised. And this is something we really need to be cognizant of. In terms of where the market is moving, Nifty, the BSE and the auto index, these indices are very overbought right now. So my point is that if one really goes by the technical indicators right now, very few pockets are there which are in the buy zone. That includes energy, pharma and infra. And that is where if in a bull market, what will happen is that the overbought sectors, they will get into consolidation or they will get into sideways movement. But if the market, and since this is a bull market, I expect the underperforming sector now to start rallying. So in the second half, I will not be surprised as the market moves into some, as the froth settles down, the market action may really move away from IT and away from some of the real estate stocks. It really could be back to banks and selective FMCG.
Well, talking about the texture of names that have been holding up off late, look at the list of stocks which actually held out by more than 15% yesterday, and just stacking it up with the profitability that they have: MMTC, Dish TV, State Trading Corporation.
So Aisha, look, you have to look at price action, and the price action has to be again substantiated with what is happening in terms of the profitability of the company. And some names here are Dish TV, MMTC. These stocks are up 20, 15, 18, 20% from the recent lows. And look at the profitability what they have, whether it's 3i Infotech or MMTC or Dish TV. For FY23, they've reported fat losses. My limited point here is that if you are really buying some of the companies which have very little operating profit, or in the near term do not have potential really to report a strong profit, and the stocks are appreciating, then that is pure momentum. And this is my limited point here, that why do you want to avoid, you really want to avoid the temptation of buying strong momentum. Don't get trapped into the price action, because when markets will adjust, some of the stocks which have appreciated where the fundamentals are slightly shaky, the end game really could be slightly poor.
Oh yes, indeed. Clearly can't get trapped with some of those names because the numbers really speak for themselves. But it's interesting, the biggest contributors as well for the mid-cap index have been the likes of a Shriram Finance, REC. We've been mapping out the returns from that PSU space. PFC as well, IDFC First, Indian Hotels as well has been one of the biggest contributors within the mid-caps. That aside, let's also find out what exactly the global commentary is, what the likes of some of the top global commentators have to say about the setup. We've got Vinny here to walk us through just that. Hi, Vinny.
Hi, good morning, and let's talk about the global commentary, and we'll start with the first commentary that is coming from Mohammad Al-Arian. He's talking about, how the most concentrated Fed rate hike cycle has come in the decades, and now he's highlighting that this is something that is undermining the supply side of the housing market, as well as keeping the prices high despite the lower demand and aggravating affordability challenges, which is facing a first-time buyer, a particular issue on that front, and that is a major issue that he's highlighting, that, despite everything in terms of the increase coming in the Fed rate hike cycles, we're seeing that lower demand, but the prices for housing is still higher in the US market, and that is a concern that he's highlighting. Now, moving on, we also have the commentary that is coming from Lawrence Summer, and he's highlighting that whenever anybody actually says that they care about producers, not low price for consumers, they are adopting a negative sum, all against all vision of the international economic policy. Also, we have the next commentary coming in from Peter Schiff, that he's highlighting that as long as the government will be actually spending money, which actually doesn't exist or they do not have, inflation will continue to get worse. And obviously those renewed inflation pressures are building and evidenced by the oil prices seeing a jump, bond yields are seeing a rise as well, and the job market meanwhile and the economy are showing signs of weakness. So these are major concerns that he's highlighting in terms of the spending that is coming from the government for something that they still don't have, and the money that they still don't have is causing a bit of an issue and more pressure in terms of inflation.
Okay, we leave it at that. That's the macro setup. Getting a little bit wobbly, what with the movement in crude, other asset classes like Bitcoin. or for that matter, what's happening with the yield as well. But this morning, the GIFT Nifty indicating once again a very, very flat start for us. But let me take it across to Kunal and Naresh and find out what they're mapping or how they're mapping what the trading day is going to look like. Kunal, Naresh, hi morning. Kunal made it to 19,650 actually on the futures. What's next? Do we see the mid and the small caps correct while the index holds quiet, or do we see some push on the index too?
Good morning, Aisha. So I would probably expect that this trend would continue for some more time, that the mid caps and small caps can stand to outperform, because the major fact is that not too many large cap stocks are actually showing any signs of comeback. So there have been few comebacks from large cap stocks, like for example Maruti, which was a big underperformer. That stock has made a very good comeback from the auto pack. But then when you try and look at this as a pack, like Reliance, HDFC Bank, ICICI Bank, Kotak Bank, many of those large cap heavyweight stocks in the Nifty 50 as well as in their respective sectors, you're not seeing any major kind of a revival. On the other hand, the volumes, the delivery data is far more attractive towards the mid cap names. I'll also agree with Nikunj's point that the mid cap and the small cap index, they're entering into some sort of an overbought territory as of now on the weekly charts. But the only concern is that the overbought territory for these stocks, in fact, the RSIs for these indices are just in the tune of 77 to 80 odd for the small cap and mid cap index respectively. It has to reach those extreme frothy zones of at least 85, 88 for us to maybe call in for a major caution signal from the mid cap and small cap arena. So that's the only reason why I would probably believe that this trend, which we are seeing in the last couple of months, that the mid caps and small caps can outperform, I think that trend should continue for some more time.
All right, let's get in Naresh's technical perspective as well. And Naresh, what is it that you're making of the fact that we did see some leadership now coming in within the large caps, the likes of RIL, ITC, Infosys contributing yesterday?
So we are yet to see a cleaner breakout above the 19,600 mark and the 45,000 mark on the Bank Nifty. Till the time we don't go above that on a meaningful way, we are still stuck in the band. The band remains at 19,250 on the lower and 19,550, 600 on the upper end. Now, the only case which comes up is, at least for the next few sessions going forward, the small cap and the mid cap indices could take a little bit of a pause. They may not continue at the same speed. We've started seeing some bit of selling from higher levels over the last two sessions. Until now, it was open up, close up, and this has changed to seeing some sort of volatility on the downside and not able to hold on to the highs. So we could be seeing a point where we could see performance getting focused more on the larger caps, or maybe we get into a sideways zone for all of them. But once we sustain about 19,600, that is the point of time you change the stance towards becoming purely focused towards the large caps. So as of now, the mid caps and small caps have done well. But the thing to put on radar is, once we see some leadership from the heavyweights, we could actually be looking at a focused large cap view going forward.
Okay, let's find out then those top recommendations from both our chartists. And Kunal, what is it that you're flagging off?
So I'll go with DLF as the first stock to recommend as a buy. The stock looks attractive. Yesterday, I think the stock closed at 525 odd levels, which is also the fresh high for DLF. So would recommend a buy with a target of 550, stop loss at 509. And Glenmark Pharma, I think many of the pharma stocks are making a slight comeback for themselves. So Glenmark Pharma looks attractive. Stock closed at 785 plus levels. So would look at a buy with a target of 805 and stop loss at 772.
Right. Naresh, what's on your radar in terms of stocks?
So first is a buy on ONGC. The stock has sustained above the 180 mark for the last few sessions, and clearly a multi-year breakout on dividend adjusted charts as well as on the last 1 to 2 year charts. So finally, the stock seems to be changing trends and could see a big re-rating going forward. A short-term target price of 200, a medium-term target price of 240, stop loss at 178. Second is a buy on IndusInd Bank. The stock has been showing relative strength over the last 3 sessions with the Bank Nifty. 1430 to 1440 has been a resistance for the last almost 4 weeks. And this might be the 4th or the 5th attempt around that area. If it can sustain above 1440 levels, it would be a breakout move towards 1550, 1600 levels. So a preemptive buy here with a stop loss at 1390.
Okay, that's the take coming in on what the trades are up and of course individual stocks are looking like that you should be keeping on your radar. But let's also address crude. The fact that it's already at a 10-month high and it's escalated all the way to that $90 per barrel mark. Let's bring on board Peter Maguire and get in some perspective there. Peter, hi, morning. Good to have you on the show as always. Peter, what's leading to the crude rally and do you see a further escalation above 90 on the Brent?
Well, good afternoon and good morning and good afternoon from Sydney. A couple of things. First off, you've got that Russia and the Saudis as far as those extra cuts, rolling those out to December. There's the great concern, and that's really put I think more horsepower behind this big rally that we've seen over the last 7 trading sessions or so. You're up the best part of 7% or maybe even 8%. It's given back some of that hot steam from this morning about 6 or 8 hours ago. But still, we've got Brent sitting at $90.20 and WTI just short of 87. So I think there's more hurt to come.
So your sense, Peter, that you're getting when it comes to the worries about the supply shortage this after Saudi Arabia and Russia extended their supply cuts to the end of the year?
Yes, well, there's the first part of it. Yeah, I think it's really going to impact price. So we understand their conditions, what they're trying to achieve, and naturally, I think the uncertainty across the whole sector it was severely sold down as far as the producers were concerned, and it's rallied very, very strongly in the last couple of months from that early 70s all the way through to early 90s. And there seems to be further upside ahead of it. Many traders are now saying $100 achievable in September, and I won't be surprised if it takes that number out.
Oh, really? That's your projection. And how is it that you expect then OPEC is going to proceed now with its oil production strategy?
Well, I'm not suggesting that's my headline number, but I'm just using what the traders are saying out there, and I'm across many different, I suppose, groups that I talk to, from producers all the way through to big hedge funds, and they're all saying it's achievable. There's the first part. The second part is the overall size of Russia and Saudi. They're the elephants in the room when it comes to OPEC and OPEC plus, and they're taking the lead on this. So they're really joined together at the hip, and they're quite aggressive with what they're doing moving forward. And this is all the way out to December. So I think it's going to be quite fascinating how we're running into October and November, whether we see some respite from them come early 24.
Your time. Thanks so much, Peter, as always, for joining in and taking us through your projections and analysis on where crude oil could potentially be headed. All right, let's move right on. Get stock specific. What should you be watching out for in particular in today's trading session? Well, let's begin with discussing a sector that we never tire to talk about, and that, Anisha, is the power sector. What's CLSA's view?
Oh, well, yes, we didn't used to talk about it last year or even a year before that at all. It's only this year that it's come back in focus.
This month especially, I guess.
Look at the year moves. I mean, the likes of SJV and etc., which didn't used to move, is up a solid 80% this year. NTPC, these are called the defensive, just the dividend yield stocks. They are higher by anywhere between 30 to 40% on a YTD basis. And the month of August as well has been very, very strong for the generation, and that's what CLSA is talking about. That the fact that, of course, it was one of the driest August that we had seen given the El Nino impact that came in, and on account of that we have seen a solid double-digit growth in the month of August. Street was expecting a generation growth of maybe 10%. The number has actually come in at 16%, and no surprise then that very recently, a couple of days ago, we hit that peak demand number as well. So a lot of things are looking positive for the sector. They of course are more positive on the utilities because the likes of NTPC etc., because they have a larger market share and they have been doing well. But separately, they're also talking about how the merchant prices have been going up, and that's a trend that we have for you on the screen as well. We took out the average clearing prices from IEX for several months. Earlier, they used to be in the range of around 4 to 5.5 rupees. In the month of August, given the fact the street was not expecting such a demand, that actually went up as high as almost 7 rupees. Merchant sale is something a lot of these companies like JSW Energy, Tata Power, etc. indulge into, because NTPC and others have largely the PPA signed, so they do not have much transactions happening in the open market, but the private companies stand to gain more. And Nikunj, we've seen a solid rally in many of these names, and ahead of election, I think this is going to be one of those focus area yet again.
No, it's nothing to do with election. This is pure merchant power pricing. So power companies, they sell by two routes: PPA, where they've contracted with the with the discoms in this case for supply power at a particular rate, and these are multi-year contracts. Second is the merchant power pricing. Merchant power pricing is where they have flexibility. Now this is almost like a cycle which follows. First fact is the cycle is strong. B, there is a big change in the way how the consumption patterns in India are emerging, both in terms of the peak demand and also in terms of the evening demand. So there is a demand uptick, there is a change in terms of pattern. It's very simple that if you have a ready capacity and if you have more percentage of total revenue which is coming from merchant power, in the near term you're going to be benefiting because of that disproportionately. Private companies are the ones where you have large amount of contribution which will come from merchant power, unlike some of the PSU companies. I'm pretty much repeating what Anisha in a sense have flagged off. And which are the companies which are going to be benefiting largely because of that? Well, to some extent it really would be the Adani Group. Then second it would be the Jindal Group. NTPC and some of the other government power utility companies are unlikely to see that kind of an upside. Also, the whole chain changes, energy exchange, because the transaction will start happening there. They also will start getting a benefit of that. So this entire power space which has rediscovered momentum, now what you actually see is that companies which have a strong focus on merchant power, they are the ones where I think in the near term, considering the demand is strong and they have a ready capacity, it could be in for a boom time for them.
No, but the question is, can you still get in and make money on power names?
Aisha, I think the demand is strong and not every power company will make money. I mean, now you will actually have to go back to see. There are two factors here. One, coal prices have gone higher. So what markets are anticipating in terms of the uptick also will get slightly challenged. But I guess if the power cycle is a 2 or 3 quarter cycle, some of the merchant power companies are in for a sweet spot. And given that this market right now is bereft of good ideas, not too many large cap stocks are available very cheap, hardly any value is left in any of the so-called defense and railway names now. This really could be a quasi bet in terms of the policy advantage and in terms of the demand versus supply availability.
Right. Geo Financials, Anisha, last day of trading on the index.
Oh, well, yes, tomorrow it will be kicked out of Nifty 50. This is something that we already talked about. The precursor happened in terms of the circuit filter revision when it went up to 20% versus 5%. But yes, now it's officially out that Geo Financial Services will not be part of Nifty 50 from September 7th, which is tomorrow itself. What will be the impact of that? First, of course, there will be an impact on account of the passive flows. Today, around 3 p.m., expect a big move happening on Geo Financial Services because almost 105 million shares are likely to be offloaded on account of those passive adjustments that really happen. So watch out for that. But what happens after that? Well, the real price discovery is likely to happen given the fact we had seen that the stock has been very volatile since its listing. The discovered price was close to 260 rupees. Then it was locked in lower circuit for many days. Almost tested a level of around 200 rupees and then bounced back. But I think now is the time, Nikunj, that the real value will emerge and people will start discovering and start valuing it on a fair value and business basis and not just, index flows and all of that.
See, Anisha, large part of the index adjustment, I think today hopefully should be over because, funds, they normally have to limit themselves in terms of tracking error. So by today afternoon, you would imagine that the residual compulsive selling, which is going to be coming from the index, I think by the index managers, I think that really would be over. And once the compulsions are over, the fair value discovery actually will start. The way I look at Reliance Jio is that Reliance Jio has a promise, it has a potential, it has all the necessary ingredients that it can really scale up and it could have a disruptive impact. But for Geo Financials to scale up and exhibit something in terms of profitability, what kind of range of services they would be offering, it will take them at least 12 to 18 months and maybe beyond 18 months to really have a sizable presence in the distribution market, in the financing market and also in the lending market. So till that time, I guess there would be a little bit of leap of faith there would be an assumption that it has got a good pedigree and they will continue to deliver because they're from the Reliance stable. But to ascribe value to something which has just taken a birth right now with the assumption that next quarter they will start running and they will start demonstrating a good earnings trajectory, I think that would be impossible. So I think now the stock could just settle into a broad range, so to speak, and markets now will wait for the numbers. The way I look at Geo Financial is very simple. I think it's a startup with a very large balance sheet. It's got scale, size, reach, and the power of Reliance brand.
All right, there you have it. Thanks, Anisha, for joining in and flagging off those stocks to watch out for. Well, let's hear it out then from one of the key investors in the Indian landscape, and that is Rajan Anandan of Peak 15. He says there's never been a better time to invest in India or build in India. He also says that Peak 15 has about 20,000 crores of dry powder for potential investments. Listen into this excerpt.
Never been a better time to invest in India. And there's also never been a better time to build. So we continue to be very active. As I said, we have over 20,000 crores of dry powder. Yeah. We see opportunity in many different sectors, right? From AI, from software for the world, from India, from consumer products, from gaming, from travel, from financial services and fintech, which is sort of what we're talking about at this conference, as well as Indian entrepreneurs building for the world, right? So software companies. Let's take, one sector we haven't talked about is manufacturing. Right? Manufacturing is now beginning to boom, and what we're also seeing is very interesting companies that are using IP-based or process, like new innovative processes to manufacture products at either a significantly lower cost or significantly better quality. So today we're seeing innovation everywhere in India. So we couldn't be more excited about the startup ecosystem in India. It has a twin engine innovation ecosystem, okay? One engine is focused on innovating for India, and that is across sectors, right? We are seeing extraordinary set of new consumer brands being built in beauty and personal care, in food, in fashion, in health, right? So that's just consumer brands. You look at gaming, you look at travel, right? We've made several travel investments, online travel investments over the last 3 or 4 months, right? If you look at, we are here at Global FinTech Festival, you look at financial services. India today has $1 trillion consumer credit gap and $1 trillion SME credit gap.
Back with the market right here in ET now, and the GIFT Nifty is indicating a very, very quiet start for us. While the global landscape is also looking a little bit wobbly, and it's been a bit of a weak handover from both the US equity markets, or for that matter, how Asia as well is panning out right now. But let's try and understand all the stocks and segments of the markets which are going to be on your radar this morning. And a slew of brokerages are coming out with a bullish stance on India per se. What's supporting HSBC's constructive view on Indian equities? Let me take it across to Shesha and get in more details.
Well, yes, HSBC has come out with a note on India's strategy. First up, they've spoken about mid-caps, where they say that mid-caps have rallied hard, which is a key symptom of a bull market. As far as premiums are concerned, they say mid-cap valuation premium stands at about 34% versus historic peak of about 40%. Analysis of cycles suggests that we are still midway and probably some jump up is left as far as cyclical recovery is concerned. Broader market bullish phases can still last, and there's still run up which is left in this cycle. Rising crude, food inflation in the near term are the key risks to watch out for in their view, while they remain constructive on the overall Indian equity market, which they believe will stay in the bullish phase even now. Any consolidation they believe is likely to be shallow and short-lived, and hence they perhaps believe that there's some run-up left in this equity market. They believe that India stands out, which is on account of the combination of strong GDP growth and resilient earnings outlook that they have in the coming quarters. They've listed out 12 key ideas in the Indian equity market: Jubilant Food, Nykaa, UPL, Torrent Pharma, Petronet LNG, Sobha, Prestige, Hero Motocorp, Volta, Zomato, and from the BFSI segment, they've jotted out M&M Finance and Equitas Small Finance Bank. So these are the 12 key ideas that they've come up with in their India strategy note.
All right, that's interesting. Thanks very much for highlighting those details. Well, speaking of, Citi in its latest note has said that the capex cycle recovery is on track, and they remain very overweight on sectors like capital goods, defense, and even CVs. What exactly are the highlights of that note? We've got Vinny here to break it down for us. Vinny.
What the key highlights are coming in the India strategy note is talking about the momentum that we have seen coming in the capex cycle. They believe the overall conditions that are there in the country are still very reasonable. They remain favorable for the ongoing recovery that we're seeing in the capex cycle. They believe that the sustained public capex momentum and gradual improving trends will be something that will be driving the private capex as well. Let's not forget that this is the year before the election, so they believe that the public capex also will be something pre-elections will also see an increase coming there, and the government funded infrastructure capex will likely pick up this year to 22% growth on a year-on-year basis. That's going to be railways, road, power projects, which will also include some of the renewables. That could be something that will be leading the growth over there as well. Now, overall, in terms of the private capex trends as well, what they are highlighting is that the cities analysts are saying that they had highlighted previously also in terms of the capex funds that are tied up with private corporates suggested a good momentum, and total sanctioned private corporate capex that has also started seeing a very healthy pace of improvement since FY19 as well. So they expect that momentum will be something that could be continuing for the capex cycle as well. And obviously that's just why when you look at it, what they're saying is they're reiterating their overweight stance on capital goods, defense and CVs, and they're neutral on selective stances on the cement space as well. Now, the preferred stocks come in at L&T, BEL, Adani Ports, Ultratech Cement, Ashok Leyland and ACC are their preferred bets in this play.
Okay, we'll leave it at that, Vinny. In fact, the RBI policy approach should be balanced. That's the word coming in from the RBI governor himself. He says that too much of it may actually confuse the markets, while too little may actually misguide.
Reiteration by the central bank that we are committed to 4% as we have been doing time and again, and the fact that we again recommended to government, despite the fact that inflation was prevailing at that time upwards of 5% and touching 6 and sometimes above 6, the fact that the Reserve Bank recommended 4% and stuck to that target also established the credibility of the monetary policy framework and also gave confidence to the market and also helped in anchoring inflation expectations.
All right, let's connect then with Dipan Mehta, who's joining in right here on the show to share his outlook on the markets. And Dipan, something that we've been debating for quite some time now. If you look at the year-to-date move on the frontline index or even the Nifty Bank, it's done precious littles, but it's been the mid caps and the small caps that have shown you very stellar returns. Just going back in history as to what this trend has really proved in the markets before, or your assessment and reading, what is this trend indicative of?
Good morning and thank you for having me on your show. I think this is part and parcel of a multi-year bull market, and we typically see this phenomena play out that first the large cap stocks make the move, the Sensex Nifty first make the first move upwards, and then a lot of catch up is being done by small mid cap stocks, and that's what's playing out over here. At some point you'll see a correction in the small mid cap stocks, and then the large cap stocks will start to move up. I think that point will be reached when we see significant FI inflows, because even as we speak, the daily FI numbers are negative. So it's only when allocations increase and more money is pumped into the large cap sort of index stocks is when we will see the large cap spectrum also move up. But for the time being, I think it's a great trend. And what we're observing is that a lot of portfolios are doing very well for investors. And I think investors who have conviction in equities, who have stayed with their SIPs and invested in stocks last 2-3 years, they've all been rewarded with handsome returns. And that certainly, I think, means the more and more money will come to the equity market over the longer term at the expense of other financial assets. So it's a very good trend. And I know a lot of mid-cap stocks may have become expensive on a trading 12-month or FY24 basis. And of course, there could be a correction at any point of time. But broadly, I think the underlying fundamentals of the Indian economy and the corporate earnings remains quite sound. And we are in a nice, I would say, a virtuous circle where sector after sector is doing well and pulling up even some of the sectors which are not doing well.
Sure. Let's look at sectors which are doing well, and let's just reiterate that note by CLSA on this power sector, saying that power demand has clearly spiked as El Nino strikes. It's been the driest August that one has seen in the last 22 years, which is clearly driving demand. Having said that, Dipan, most of these power stocks have already been running up quite a fair bit. There's NTPC, NHPC, which is clearly finding favor in the market because they are like, the regulated utility, so to speak. But do you think, can one enter into the power stocks now and still make money? And B, if that be the case, what's your preferred list?
See, generally, we don't prefer utilities like power companies because our preference is clearly for growth companies, and there's a lot of action in electronic companies, or basically companies which supply to the power industry or the energy industry, be it transmission or even power generation. I mean, you see the numbers which come through from MNCs like ABB, Siemens, which are critical in that sector. They have done phenomenally well. They're expensive, no doubt, but look at the order book position which is shaping up over there. And then there are the transmission equipment manufacturing installation companies likes of KEC International, Kalpataru Power. They also have been reflecting very good numbers. And last year, I think even BHEL has started doing very well and looking at kind of a 3-year type of a order book position, which is all because of increased capacity being set up for power generation. And there's a dark horse like a Suzlon or Inox Wind, which is bang in the middle of this renewable energy space. So there are many other stocks, I would say, which are engaged in setting up power plants or setting up transmission lines, where we feel the prospects are far better, far more visible and available at reasonable valuations as compared to buying into a power utility company.
What's the sense that you're getting, Dipan, when it comes to the entire underperformance of some of the marquee large cap names like a Kotak or an HDFC Bank, which has obviously led to pretty negligible returns for the Nifty Bank as well for the last 6 to 8 months?
I think it's a matter of time. These stocks will start to perform, and within a month, you may see them go up by anywhere from 15 to 40% as well. It's just that right now the money is flowing into small mid-cap stocks. We are seeing a lot of inflows into the mutual funds which buy these small mid-cap companies as well as PMSs. So that's where the fund is moving in. But a point of time will come when foreign money will come in droves, and that will go to the Kotaks and the HDFC Bank and the Reliances. And that's when these stocks will start to move up. You have to understand that there's only so much that the small mid-cap stocks can move up. End of the day, they take their valuation base from the large cap stocks. So unless you don't have large cap stocks starting to move up, you cannot have mid cap stocks being traded at such a high premium and such a huge gap compared to the large cap stocks. So it's a matter of time. And actually, strategically speaking, if you have a trading mindset, then fresh money should be deployed in the large cap index stocks. Maybe trim some positions in the mid cap counters as well as a measure of safety.
That's a very interesting point. Kunal, would you agree with that on the charts as well? That maybe it's time to take some money off the table when it comes to the small caps at least. And if you were to allocate fresh money, that should be within large caps. Or would you say stay with the trend and stick it out with the mid and small caps?
See, I think it's got to be a mix of both, because there are few stocks, for example, we were discussing this point, I think, a couple of days back, that many of the stocks in the power finance space, the likes of PFC, REC, they've reached their extreme overbought territories on the charts. And you see in the last 4 or 5 days specifically that these stocks have halted that rally. They are not participating in the mid cap and the small cap frenzy or the rally which is going on. And you're seeing those tad bits of intraday correction which has come back into these stocks. So there are spaces of few mid cap stocks where the momentum was exceedingly high. The price rally was very sharp. Those stocks and those sectors, they have gone through a halt. But on the other hand, expecting that large caps should start to participate, the only concern with this point is that the timing aspect. Because when we look at a turnaround for these stocks, it's always best to wait out for even the first signal, which is either a price volume breakout or whether these stocks come back to hit their 3-day, 5-day swing high. Whenever that happens, even if it's a couple of percentage points higher from the current levels for these stocks, or whenever that breakout happens for these stocks, it's always prudent to buy the stocks, because then you would have a better risk reward, both in terms of timing as well as in terms of price. So I agree largely to the point that maybe you can take some chips off the table and wait out for those large cap stocks to start showing signs of a first turnaround. I think that could be a better timing for these large cap stocks.
All right, there you have it. That's the view coming in. But let's move right on and look at some of the top management meets. Jefferies has collated the key takeaways that they had with ABB India's management, while Investec has noted the same from RBL Bank. We've got Sharad here with the details. Sharad?
Well, yes, at first ABB India is in focus, and their management key takeaways include that the customer focus would be there coming on the quality delivery as versus the price negotiation. Now, overall, the target market which they will be actually catering to is worth almost 11 to 12 billion dollars, and also the management has stated that the growth is coming beyond tier 1 cities, and also a strong capital formation is being seen in tier 2 and tier 3 cities. Now also, of course, the numbers going ahead, they have maintained a double-digit net profit margin growth, and the band is expected to be coming between 10 to 12 odd %, and also they're estimating a double-digit quarterly order for inflow growth as well. Now, apart from ABB India, RBL Bank is also in focus, and as for the Investec, the key takeaways do include that from FY23 to FY26, the bank is aspiring that the advances and the deposit expected to grow between 20% CAGR, and also they've stated that the focus would be coming on the retail loans, and as they'll be actually reducing their whole share book as their balance sheet has actually improved. Apart from this, also when it comes to NIMs, they have estimated that they are expected to materially improve over the next 3 years itself, as there's a change coming in the product mix. Lastly, also coming in is the return on asset that is expected to push upwards of 1% going ahead.
All right, thanks very much for giving us that heads up. Meantime, Dipan, just curious then to get in your take as to how you're looking at the overall real estate space. Reports are indicating that in the festive season, we could see a jump of nearly 15 to 20%. In light of what's expected, where is it that you're finding comfort within realty?
First, I think a general disclosure, I would say that at this point of time, looking at the way small mid-cap stocks have rallied, although they are great businesses in whichever industry they are, I don't think that we are pursuing them or we are making any fresh commitments in those stocks. So we just want to just wait and watch, and we are expecting a correction. It could be around the time when the earnings season starts, because these kind of expectations may not be matched in the short term. So from that point of view, whether it's real estate or banks or mid-cap banks, mid-cap NBFCs, anything I think which is small mid-cap, which has rallied by 30-40% or maybe double, triple over the last 1 or 2 years, we need to just make a pause over here. I think that will serve us very well going forward, and it will help us create the necessary cash to invest when in fact there's a correction. Having said that, I think real estate stocks also have rallied significantly past few months or so. We are seeing a kind of a multi-year cycle upswing in the real estate space, and all real estate companies thankfully are focusing on execution and on sales and on managing their balance sheet. So from that point of view, it's a great trend from an industry and a stock market perspective. So having said that, I would just like to be a little cautious when it comes to real estate companies. Although we have our preferences and we have investments as a measure of disclosure in companies like Godrej Properties, which we are very positive on because of the corporate governance standards and their execution and deliverable skills. Or even companies like DLF and Macrotech, which are really large and have a diversified portfolio, although concentrated in one area, we also deliver good returns over a period of time if you have a long-term view. But for the time being, I think it's better to just wait and watch. I know these mid-cap stocks have rallied significantly, and it doesn't take much for them to come off by 15-20% also when the chips are down.
Dipan, is the view same when it comes to the large infrastructure/construction names?
See, I think over there could be some opportunities on companies like NCC, I would say PSP projects, disclosures again required here, which are still available, perhaps at reasonable valuation. And these are the companies which we cover, so I know, but I'm pretty certain that there are many mid-cap engineering construction companies which are available at reasonable valuations. And they typically have a 3 to 5 year type of order book position. So from that point of view, there's good earning visibility. But there are some pockets of, I would say, stocks which have rallied significantly. And one name which comes to mind, again, disclosure, is ITD Cementation, which has rallied significantly in the last 2-3 months or so. So again, you need to be a bit selective when it comes to any fresh investment in any sector when it comes to small mid-cap stocks. Of course, there'll be a few stocks which have not done as well, which are lagging. You could look at that if you have a compulsion to invest in mid-caps. But by and large, I think it's best to just wait and watch. And I think that at the correction, a lot of these engineering construction companies can be an interesting investment opportunity. And we like best is the visibility which they have as far as the earnings are concerned. And a lot of the orders which they have in their bag at this point of time, I think, are at reasonable value, reasonable margins as well.
Sure. Naresh, would you like to come in? What's looking most interesting on the charts? I mean, Dipan just flagged off an NCC, PSP projects, etc. Anything that you track?
So out of these names, say NCC has done quite well. So at current levels, this is not interesting. So the stock which looks interesting are the names which have not done well. So one is a KNR Construction, which has just remained at the same place for a long time. So that's one stock which could actually take some leadership. And over the last few days, it has started showing some momentum. So 270, 280 has been a resistance for the stock for the last 1 year. So this could be a stock which was one of the first participants in the previous cycle in 2014. And from 2018, it has not done, 2021 it has not done much. Second is a IRB infrastructure, which has started giving a breakout, trying to make a 2-year high. Again, every time the stock has come to 33 odd levels, it has flopped. So that could be a breakout, which could be interesting. So the two names in infrastructure would be IRB Infra and KNR Construction, which look promising.
That's the take coming in on some of these construction plays. Let's bring up Paytm as well and show you where that stock is headed, because Citi has come out with a very interesting note. They're maintaining their buy and they've put a target price of 1160 on Paytm now. They're saying that robust August trends, devices competition is only heating up. They're saying Paytm's leadership in devices has several durable advantages and should persist, and that they are aggressively lowering their rentals, upfront pricing, misaligned sales incentives are something that they see for the industry. Vijay Shekhar Sharma, of course, has made it categorical that there are no further plans to increase stake after what he bought, the Anfin stake, that is. Dipan, how are you now, reading into the developments at Paytm?
Well, I think the company is shaping up phenomenally well. We like the transparency, the fact that every month it discloses the kind of traffic on their website and the number of new loans which they have generated for their partners. And on the whole, I think the company is really, taking full advantage of the platform it has set up. There's so much of acceptance of these UPI payments. And now I think even lending over such platforms will become possible. So a whole host of opportunities opening up for Paytm. My sense is that it's a high operating leverage business, and at some point of time, it'll start to generate serious profits. And by then, I think the stock would have rallied significantly from these levels as well. But you need to have a strong conviction to buy into a story like Paytm, and you need to have a very long-term vision as well. If you look at some of the other comparable businesses, mildly comparable businesses which have done exceptionally well in these spaces, companies like Bajaj Finance, which have gone totally retail into loans and retail products, and see how well they've done over the last 10 years. And then you can kind of project or kind of think how Paytm can do over the next 10 years, given their technology, given their platform and their fantastic execution, as well as their brand. So I'm very positive on Paytm, although we don't own the stock, but it's bang in the middle of our watch list. And as I said, I think, whenever there's a correction or at some point of time when the numbers surprise us in Paytm, we certainly look ourselves as long-term investors in that stock.
Okay. Bajaj Finance this year is up 11%. But if one looks at the Bank Nifty in this year, the Bank Nifty perhaps has done precious little. And I go back to that same point, Dipan, that for banks, whatever could go right has gone right. For IT, whatever could go wrong has gone wrong. And look at the market action this year. IT has managed to pop right back up, and banks, in a sense, have become obese and they're hugging on to the flat line. Going forward, do you think this disconnect of IT versus banks is real and it's here to stay?
Good morning, Nikunj. I think markets are forward-looking and they are expecting that the worst for the IT sector is over. Very impressed with the kind of new order wins that come through from the large cap IT companies, and that even also some of the commentary coming from mid-cap IT is that maybe a pickup in orders just around the corner. A lot of the macroeconomic risk factors are gradually reducing. It's pretty clear that US is going into a soft landing, and that certainly will protect a lot of the IT spending from that perspective. So because of that, I think investors are looking ahead. Maybe 6 to 12 months from now, you may have solid numbers coming through from the IT sector. And on the other hand, I think banks may face some amount of pressure when it comes to the net interest margins. Also, I think the base level for banks is rapidly increasing. So, trying to lend responsibly at such high base also in the interim may cause a bit of a problem. And I think the biggest problem with banks at this point of time is over ownership. I think every portfolio has got a high exposure to banks, and from that point of view, I don't think that they want to add any more banks to their portfolio. That also, I think, is one of the factors to consider. But there's no denying that, if you have a longer term view, 3 years, 5 years or so, then banks, NBFCs, which are doing lending in a responsible way, which have a great track record when it comes to NPAs, will certainly deliver good returns. I mean, look at it this way, even if the price to earnings, price to book remains constant for the next 2-3 years, these companies are still growing top line, bottom line at anywhere from 15 to 25%. And those kind of returns then can be expected because the earnings per share could move up by 15 to 25% year on year over the next 2-3 years.
Dipin, if I could just prompt you for a frank and a direct view on this one, and let me phrase my question carefully because it is about railway stocks. For those who own, what should they do? For those who plan to buy, what should they do? And for those who have a 3-year holding period, what should they do?
Nikunj, I always give my views in a frank and straightforward manner. If you're holding railway stocks, then just smile and be invested. Brace yourself for a correction whenever it is. But these are companies which have got good earnings visibility for next 3 years at least. And so from that point of view, you have nothing to worry. You've taken the right decision, so remain invested. From a fresh investment perspective, as I said, which is true for all stocks, 15, 20%, 30% type of a correction. And that could easily happen because, these companies can have a bad quarter because of, internal issues, market dynamics. Doesn't mean that the long-term prospects are bad, but a bad quarter, stock correct by 25, 30% may be a good entry point. But at this point of time, I don't want to chase these stocks. They've run up phenomenally over the past few months or so. And valuations are also on the, I would say, on the higher side, given that track record. Of underperformance and stagnant earnings. So I would just like to wait and watch just now. Existing investors, I remain invested. From fresh investment, 15-20% correction.
My follow-up question to that, Dipin, is that someone is of the view that, look, I can take a 15-20% volatility, which is par for course after the recent run-up, but I have a genuine 3 to 5 year time frame. If that is the criteria, a 15-20% downside acceptable, and a 3 to 5 year time horizon, should one stick to railway stocks across the basket? Because I've seen one thing, Dipin, that we are talking about a category here. Markets right now are not differentiating between RVNL and IRCTC or RNL.
Yeah, that's right. I think, it's very easy to say that I'm prepared for a 15% type of a correction, but when it actually happens, you don't like that feeling. And I've been in the market for 30 years. I'll tell you one thing. That the worst situation is you buy the stock, intuitively that stocks are trading at very peak valuations. You buy the stock and it corrects by 15-20%. And, you kind of regret that decision. So it's not that, people have a gun to their head and they have to invest, in railway stocks. There are so many opportunities in this market. And it's also one needs to consider, Nikunj, that a lot of investors have been investing in the market. They have got good portfolios in position. Of course, cash levels may keep on increasing because of incremental savings. But I think from a timing perspective, I feel like normally I do not try to time the market, but from a timing perspective and the way these stocks have moved up and what valuations they are trading at and the kind of expectations which are being built into, I intuitively feel that you're going to get disappointed pretty much soon over the next, 2-3 months or so. So from that point of view, I'm just, airing words of caution and not just egging people on to buy anything at even these levels. A lot of these stocks have been huge multi-baggers, and I know multi-baggers go on to become even bigger multi-baggers. But, trying to buy them when they have corrected by 25-30%, provide a little bit of margin of safety, makes you more comfortable holding those stocks, makes you feel good about, remaining invested. And, when the correction happens, sometimes it is so, so extended and perhaps that it does tend to shake your. Investing is also a lot about managing the temperament and managing your own emotions. So you need to consider that aspect.
Kunal, on the charts, are they anywhere close to peaking out in the near term? The railway stocks, that is, your IRCTC, IRFC, Titagarh, etc.?
So I think RVNL, IRFC and IRCON, I think these are the three names which have actually become extremely overbought. In fact, yesterday the RSIs for IRFC, that's the stock which I think is around 71 or 72 odd rupees. That the RSI had hit just way above that 90 odd mark, so we can expect that stock to go into a significant cool off or a correction. IRCTC on the other hand, actually, I think that stock has not rallied significantly. In fact, in just the last 1 month, the stock is up some 100 rupees. I think from 600, 620 was the bottom for IRCTC. The stock is at closer to that 700 mark. So it's seen a very late flourish for itself. I would believe that the major part of the rally is still due for IRCTC, so that stock can probably try and catch up to the major underperformance with respect to the other peers. But yeah, I would agree largely to the point that this is the best time that you could start taking chips off the table from the ones where stocks have rallied significantly high. Buying these stocks at current levels is calling in for a risk reward of 1:0.5, and that generally is not a good scenario in this kind of a market.
All right, no railways, no defense, no Paytm, no Zomato. So Dipin Mehta, what is left?
Well, Nikunj, you can just wait and watch and just relax, take a holiday, take a few days off. You don't have to invest every single day or search for new ideas. They will fall into your lap as and when we see a correction or some blowout number coming through in the September quarter. But from our perspective, we are just kind of, closed for the next few weeks or so in terms of making any fresh investments. In any case, from October onwards, we'll have another earnings season, and that'll provide more information about what progress our companies have made and if any new ideas are coming through. There could be disappointments also, companies missing their earnings, stock correcting by 25-30%, but long-term looks great. Those are opportunities to enter into those equities. But by and large, I think it's better to just watch your portfolio do well in value as it is doing right now, and brace yourself that whatever amount you're seeing, whatever value of the portfolio you're seeing at present, you can budget for a 15-20% correction at any point of time and prepare yourself for that. And if you're leveraged, then certainly you should remove all leverage at this point of time and maybe look at trimming mildly your portfolio. Any stock that's run up significantly, you can sell 5-10% of it and create some amount of a cash pool which can be invested when there's a correction. And it will happen when you least expect it, mind and Nikunj. It cannot be predicted.
We could be in for a bit of a step back today in terms of where the market is and where the positioning of the market is. The other theme right now is the power space. And Dipin, there are two stories. There are multiple ways in which markets are excited about approaching the power theme. Some are betting on power ancillary, some are betting on power finances like PFC or RFC. Everybody is excited about NTPC, and few are now getting excited about companies which essentially will have a play on merchant power. Do you like power? If yes, and within power, which is the best leg which you are excited about?
I think power equipment companies, I think, are best placed. One company which has done exceptionally well, which has been on our watch list, is Power Industries, which is a play also on global renewable energy space. And a lot of investments are going to take place in power distribution and power transmission. So they tend to, benefit from that. The stock has been a multi-bagger. Just in the last 2-3 months, it's gone up by 50% or so. So in a way, kind of we missed that story, but we have it on our watch list. Other than that, I think companies like Suzlon Energy could be a dark horse. They've more or less cleaned up their balance sheet. Management is chasing large orders, and from this point on, you could see good numbers. There's a turnaround stock called Sterling and Wilson, which is a Reliance Group company. That also is, considering the space they are in, could be in for good quarterly numbers next from this point on. And then there are other power equipment companies, I said, like KEC International, Kalpataru Power, I think, which are looking pretty decent. So our focus is more on companies which are engaged in setting up the power generation system or the power distribution systems. I think that's where we feel the value is, and where I think there's good earning visibility. Typically don't want to invest in power utility companies because end of the day, they did not have a great track record, nor do have a great growth momentum.
Dipin, always good to have you on the show. We'll let you go on that note. Thanks for taking the time out. Okay, let's move on before we hit the pre-open rates. Let's hear our coal secretary, what he told us exclusively on the availability of coal stocks. Stay tuned, of course, for that exclusive chat. Here's a quick short excerpt.
Yeah, you are right. Last about 1 month, the demand for power is increasing because of the long dry spell. But as far as the coal availability is concerned, we all three ministries, Ministry of Power, Railways and Ministry of Coal, are working in close coordination and ensuring adequate availability of coal at all thermal power plants. We have stock of about 58 million ton at our mine end also, and we have adequate stock at the thermal power plant. The production of coal in all collieries, we are producing about 22.5 to 23 lakhs per day, and we have the capacity to produce more if it is required. So that way, as far as the coal production and dispatch is concerned, we are monitoring the situation and adequate availability is being ensured at all thermal power plants.
All right, let's get a move on then and find out what the pre-open rates are. And for now, it's looking pretty flat for the screens and at around 19,540 levels, and a quick eye on the currency as well, because we're continuing to see the weakness in the rupee, 83.02. But what are the mid-cap strategies from our chartists, Kunal?
So NBCC is something which I would recommend at current levels. The stock did pretty well over the last 2 days, moved up hard to 58, 59 plus levels where it closed yesterday. So would suggest a buy with 66 as a target for NBCC, and stop loss could be kept at 55.
All right, Naresh, what's on your radar?
So that would be a buy on Federal Bank. The stock has been leading the small cap banking name. The stock has made a new 52-week high, gave a breakout above the 140 mark, consolidating around 143, 145 for the last 3-4 sessions. Expecting it to break out in the short term. A stop loss at 140 now, target price of 165.
Right. Okay, let's also tell you what else is happening outside the world of equity markets. And chip design firm ARM says that tech giants, the likes of Apple, Alphabet, Nvidia and other big tech majors have expressed interest in buying up to $735 million shares of the company. Whether or not the said investments will work out is yet to be known, but the companies are mulling the same, reflects on the importance of ARM as a separate entity. Also, US President Joe Biden has confirmed that he is attending the G20 summit in New Delhi as he has tested negative for COVID-19. The president will be traveling to India on Thursday for the summit and will likely have a bilateral meeting with the Prime Minister as well on Friday. And India's Chandrayaan-3 mission continues to make impressive strides in new lunar exploration as Pragyan rover has recently unveiled a captivating 3D image of the lunar surface in the form of an anaglyph. In fact, this remarkable achievement offers a unique perspective on the moon's terrain, showcasing its rugged and enigmatic features.
Meantime, Shah Rukh Khan's Jawan is on a record-breaking spree with the advanced bookings. The film has already surpassed the pre-sales business of Gadar 2 to register the second biggest opening day business in advanced bookings for a Hindi film. The film so far has collected 21.14 crores from the advanced bookings. And the BCCI, meantime, has announced its 15-member squad for the ICC Men's World Cup. Hardik Pandya continues to be the vice-captain of the team. KL Rahul has been included in the squad after passing the fitness assessment of the National Cricket Academy, while Tilak Verma and Prasiddha Krishna have been dropped along with Sanju Samson.
Okay, and EIH, that's going to be the one stock which is going to be in focus today as they're set to launch their hotels in Madhya Pradesh in 2024. What else is keeping the stock in the spotlight? Sharad joins in with all the cover on this one. Sharad?
Well, yes, in focus we are having EIH, and the company is set to inaugurate 2 properties in Madhya Pradesh next year, and these properties are roughly going to have an inventory of almost 90 odd rooms. Now the company is also expected to come out with this strategic expansion plan, and it's expected that the company would be having announcements, especially on the asset light front when it comes to international expansion of hotels. Also, the street will be expecting the company's guidance, especially on the new businesses, which are generally on the higher margin side. Now, to decode it and simplify, the new business are basically your flight catering services, your air charter services, and also airport restaurants and the travel and tour services. So these are ancillary services, but having a high margin move. Also, recently the company has been off focus because it will be managing 3 Reliance-owned properties as well on the luxury front, and also looking at the stock itself, that is up more than 30% over the last 1 month.
All right, meantime, let's also get in some thoughts then on what the charts are looking like for some individual large caps. And Kunal, your take on the banking majors and what is it that you're expecting by way of trends for the Nifty Bank?
Well, for the Nifty Bank, in the last 2 days, we've seen some bit of pickup of price action. So I think from a base of 43,800, that was a low the Bank Nifty had made 2 or 3 trading sessions back. We've managed to up the level by almost 700 points. So I think 44,500 is where we are trading on the banking index. But the only concern, Aman, is that there has not been a decisive breakout of the previous resistances. So what has happened is we've been holding on to the supports, but on the other hand, there are no major signs of a breakout in terms of the resistance. Now, for example, the first crucial resistance for the Bank Nifty is the simple, 50-day moving average that lies closer to 44,800 for Bank Nifty. So we are at least another 300 points or 250, 270 odd points away from that first level of a strong confirmation of a breakout for the Bank Nifty. And when we try and look at the components of the banking index, ICICI Bank, we mentioned this point time and again that the large cap private sector banks, they are not participating. So either the large cap stock starts to fire up or the Bank Nifty starts to get into a breakout mode above this level, push the level of 44,800. That's where I believe that we would probably find the mojo as well as the momentum back.
Track the charts of a Nazara Technologies, but Naresh, that stock has been, of course, a newsmaker and has been on a tear off late. Your views?
So Nazara broke out above the 800 mark, which was the previous high in September of last year. And after that, it had fallen to 500 again. So 3 bottoms around 500, tops around 800. That has been taken out. It moved with a gap day before. But technically, any dips back to 800 to 850 zones would be a buying opportunity. It's gone through that classical 12 months period of consolidation between 500 to 800. So looks very similar to the rest of the new age tech names, which is where we saw a good correction of 8 to 12 months and now a slow and steady uptrend. So out here for Nazara also, eventually it could go towards the 1000 to 1200 mark and dips to 800, 850 remain a buy.
Okay, let's tell you what the index strategies as well are this Wednesday morning, and let's start off with the Nifty call. It's buy on Kunal's list, hold on Naresh's, and sell when it comes to Santosh Meena's call. So that's the call on the Nifty, not a consensus by any means there. For the Nifty Bank as well, it's a similar picture wherein Santosh Meena recommends selling. It's a hold from Naresh and still a buy from Kunal. That's the take coming in on the Nifty Bank as well. Let's just revisit what the pre-open rates are indicating. An absolutely flat start for us once again. Just want to revisit some of the names which are going to be in focus this morning. And Power Grid, they've bagged a sizable order in the state of Rajasthan. So look out for what that stock does. NBCC orders worth about 2,000 crore rupees. So that's going to be the other one in focus, 3% higher for NBCC as we speak right now. And Voltas, wherein Motilal Oswal has maintained a buy with the target price of 1,000 rupees per share on Voltas. That's the other stock which is gapped up about over 2.5% as we speak. Let's see what Geo Financial Services is up to. Its last day on the index today, and expect a fair amount of selling to come in the last half an hour when you will see the outflows adjustment happen. 3% lower on Geo Financial, 247 is where that stock is. Also look out for what Paytm may be up to after Vijay Shekhar Sharma's comments saying that he doesn't have any plans to further increase stake after what he's already done with the Anfin stake buy. So that's the other stock in focus. And yes, the crude sensitives, crude is now back at $90 to a barrel. So your paint companies, aviation stocks, all of would typically be sensitive. So this is one segment which is going to be in focus. That said, it's also positive news for ONGC and Oil India, the fact that crude has spiraled up. So these stocks are also going to be in focus this morning. And then Vedanta too, wherein the Zambia government has returned the control of disputed one of their copper mines back to the company. So that's also sentiment positive, holding up 1.5% as we speak on this stock. The big buzzers, of course, yesterday were the likes of Jubilant Foodworks, Aditya Birla Fashions, Petronet LNG, and some amount of sporadic activity across the pharma segment as well. Remember, Oro and Glenmark were the big movers yesterday. Oro Pharma held out by about 4% almost on the futures, and similar was the price action for Glenmark as well. So that's the other stock which is going to be in focus as we speak right now. But Kunal, purely within the large caps, what's the one sector which is looking like the weakest link and what's looking the strongest on the charts right now?
So I'll probably break it down to individual stocks, Aisha. So, the large cap stocks like the banking names, private sector banking stocks, these are looking weak. Reliance is somehow not being able to participate. So I'll not call it weak, but then the stock is due for a breakout or a turnaround of stocks. We'll wait for some momentum to come back into this name. But the other space where the momentum is kicked back again on the upside, for example, Maruti, that's a stock which has started to look very attractive from the auto pack, breaking past about 10,000 levels. Even after that, 2 or 3 days back of strong up move, the stock is just consolidating at the 10,200, 300 mark, which I believe is a very good sign for a stock like Maruti. Large cap IT stocks are managing to make a comeback, right from the likes of Infosys. TCS has made a good comeback in the last 3-8 days, some 150 odd rupees for TCS, and other large cap stocks like HCL Tech, Tech Mahindra, etc. are also looking quite attractive. So I think these are two pockets or a few individual stocks on the large cap stocks which are looking attractive.
Okay, fair enough. In the meantime, some of the other stocks as well that we'll have on our radar on the back of brokerage notes, we will be watching out for something like a Torrent Pharma. Nomura has maintained a buy. They've hiked the target price to about $21.99, saying that the potential acquisition of Cipla will be a big deal, so it makes strategic sense, and that the acquisition will require large debt and equity solutions. But the strong cash flows from Torrent and Cipla and the high promoter stake as well at Torrent, the deal can potentially be consummated. UBS has their latest note out on Petronet LNG. They've got a neutral stance, saying that it's a target price of about $235, saying that the growing electricity demand could boost the LNG imports, and utilization of the coal-based power plants are already stretched. And of course, we'll be keeping an eye out on Voltas as MOSL has their latest note. They maintained a buy with a 1,000 rupee target price, saying that the EMPS segment can recover, aided by a strong order book. So watch out for some of those stocks as well in today's trading session. Meantime, Naresh, just a quick check-in. Actually, Aisha, there's just about 30 seconds to go and we'll be bracing ourselves for the market open. Going by what the rest of the globe as well was indicating, it could be a bit of a mixed start.
Yeah, it's a flat start. That's what the pre-open rates are indicating. Where we go from there, of course, is anyone's guess. Given that the handover from the US equity markets has been weak, you have seen a bit of a losing streak come by over there. In fact, I just want to revisit what the handover was like as well, considering you've got the dollar index, which is now at a 6-month high, and, Brent has now crossed past the $90 per barrel mark. Treasury yields as well have been escalated. So that's the market construct for you. It's not looking all that great. Having said that, it's a flat start for us. We're not really feeling the heat from the global cues, at least to start off trade with. 19,570, I beg your pardon, is where the Nifty has started off on trade. Let's just revisit what are the stocks which are going to be in focus. Let's first mark what the crude sensitives are up to, because crude is now at a 10-month high because of Saudi and Russia extending their output cuts. So while it is good news for the likes of an ONGC and Oil India, it may not spell all that great for paints as well as aviation names. So those are stocks which are in focus this morning. This power grid as well, which has bagged a 20 gigawatt transmission system project from the state of Rajasthan, from the government, that is. There's maybe some relief on Vedanta. The Zambia government has returned one of the control of the disputed copper mines to the company. Vedanta holding up 2% right now. Bharat Forge, the North America Classic truck orders have seen an uptick of over 14% on a month-on-month basis. Mildly higher for Bharat Forge as we speak right now. And Voltas, very positive management commentary. They're aiming for a spot in the top 3 consumer brands. There's also a brokerage note as well. Motilal Oswal maintaining its buy with the target price of 1,000 rupees. Voltas now at 890, an uptick of 2.5% coming in. NBCC as well, which has bagged orders worth about 2,000 crore rupees. That's the other one which is gapped up 5% as we speak right now. What's Geo Financial Services up to? Already you're seeing block deals happen there. The stock a little bit under pressure. Remember, it's going to be out of the Nifty. And today in the last half an hour, you're going to see quite a bit of adjustments and outflows perhaps take place. 251.90 is where you are seeing Geo Financial Services. It's the last day that it's going to be part of Nifty 50. This Paytm as well, Vijay Shekhar Sharma categorically saying no plans to further increase stake after what he's already bought. That's the Anfin stake. Paytm starts off at 887 thereabouts. So that's pretty much what the trading construct is looking like this morning in terms of individual stocks. There's a couple of deal action as well. You know, BKG, when in the Lighthouse India Fund has sold 1.3% stake of the total 2.7% holding that they have. The Safari Industries, SBI Life has bought nearly about 1% stake in the company, wherein Investcorp PE has been the seller. So these are a couple of stocks which are also in focus. And then, of course, you know, let's just check in on what HDFC AMC also is up to. Amresh Jena, who has resigned as the marketing head, maybe sentimental negative, absolutely flat on that stock as we speak right now. Let's check in on ABFRL, Petronet LNG, Jubilant Foodworks, the big buzzers and high flyers from yesterday. And still seeing some amount of momentum, at least on ABFRL. Petronet as well is a gainer in trade. And Jubilant Foodworks will just come up for you on your screens. 536, also seeing a follow through from where we left it off yesterday in trade.
All right, let's find out what our chartists make of the market open this morning. And Kunal, what's your takeaway given the fact that it seems to be flattish across the board? And what's the first trade that you will be punching in?
Yeah, so a flat start, but I think again an okay move from many of the large caps and many of the mid caps and small caps specifically. So I'll probably concentrate there. From the mid cap, Laurus Labs is something which looks attractive, trading at 400 plus mark, has managed to show signs of coming back about that consolidation. So that's the stock which I look to trade in the open.
Naresh, what about the first trades that you're looking at?
Continuing to look at NHPC as a buy on dips for the short term.
Right. Let's just check in as to how things are trending within the small cap universe, because that really seems to be where all the action is. You've got 0.5%, near 0.5% up move there. Names like MMTC, NBCC, Sri Renuka Sugars and IDBI Bank, they're all a buzz. Add to that list something like Redington as well as Zensar Tech from Midcap IT, and they too are holding out in trade. Let's get in a quick chart check going then. And Kunal, your view, Naresh rather, your view on MMTC as well as NBCC on the chart?
So I'll be a little cautious on MMTC because over the last many years, we've seen such spiky moves on the stock and again it drifts back. The stock would be a little careful here. We've in the last 2 years also seen that spikes of quick moves and then a fade off. So not really interested in MMTC, but NBCC is interesting. The stock has given a breakout. We've covered this before at 45-50 levels now. The high in 2021 was around the 60 odd mark. We've crossed above those levels. So that's a good confirmation of a longer term trend change and a continuation. Still remains a buy on dips. Going forward, would be looking at a target price of 80 on this one.
Right. Okay.